Welcome back. Let's continue our discussion about market volatility in structuring your investment portfolio. We've discussed this a number of times on the show, and I think volatility is a good thing in the market. I mean, all three of us as traders, we enjoy volatility. It creates opportunities. Maybe for longer-term investors, it might create a little bit of uncertainty. But the one thing that I always like to look to is there's always people within the community who are standout investors or standout traders. And we're talking about investment portfolios. You know, you can look at something like Harvard University's endowment fund or Yale University's endowment fund. You know, their total returns have been impressive, to say the least, and they've done it in a relatively non-conventional manner. I mean, yes, they've got the mix of stocks and bonds, but these funds also allocate 20% of their portfolio to what they call alternative investment strategies, whether it be commodities, currencies, hedge funds, whatever it may be. That is really the key of where they generate their market outperformance. And I think people looking at this or viewing this show really need to consider that. Let's talk a little bit about the volatility.
I think there's some big problems with conventional asset management, conventional asset allocation specifically.
Let's call it groupthink.
Well, you know, if I had gone into Merrill Lynch, you know, in 1999, they would have said, "You're 20-something years old. Let's put 80% of your money in the stock market." Irrelevant of how, you know, was the fact how attractive are stocks right now.
Right.
So, you know, the asset allocation is let's put this much in this asset class, this much in this asset class. My personal philosophy, and I think this is how, and I've modeled this after successful investors, is let's allocate to asset classes due to their attractiveness. Instead of saying we need to have this much in every asset class, let's say we'll buy stocks when they're attractive. And that's what we got last month. We got a good panic sell-off towards the bottom. Right. And a guy like Jim Rogers, who I talked about last month, you know, has said, if you fade panic, you go the opposite way. When everyone's panic selling, you go in and buy it. You know, it's time to buy. They're panic buying at the top, you start selling it up. Yeah. That's the type of
right.
Well, I mean, I have a little personal story. I mean, when I was an undergrad, I actually interviewed with the Harvard Endowment Fund. I had no idea what that meant when I was interviewing.
At the time,
I was an undergrad.
I still don't know what it means.
I was an undergrad, but I mean, you know, basically the endowment is all their donors that give money to the university after they've been successful in their real life, give money back, and they've created. When I was interviewing, and this was again 20 years ago. But when I was interviewing, they had $4 billion at that time. It was the largest endowment, university endowment in the world. Today, it's over 23, 24 billion. So again, in 20 years, they've gone up 600%. Unbelievable gross return. But the thing about the way that they manage their money is, again, they look opportunistically, not I've got money, I've got to put it to work. So they look at not only stocks and bonds and real estate, but they look at hard real estate, and I'm talking timber. They'll go out and buy 10,000 acres. They'll go out and buy 10,000 acres in Florida.
They're looking for attractive asset classes.
Exactly.
To diversify, you know, but in attractive ways.
They'll buy the Amaranth Advisors natural gas hedge fund that blew up. They'll buy their assets.
They'll buy their assets for
20 cents on the dollar when they can.
Exactly. But I think the key thing to keep in mind is that there has to be an exposure to the market of some balance of stocks and bonds at all times, because you never know when the market's going to make a big move up. Unfortunately, you never know when it's going to make a big move down. But if you keep a part of your portfolio, what I would like to call nimble, meaning cash on the side that when opportunities present themselves, I think the whole concept of being able to time attractive investments needs to be looked at. A lot of people poo-poo it and say it's not possible.
People say you can't time the markets, but every successful investor in the world will disagree with that.
Right. Absolutely. So, and their returns would actually justify that as well.
Exactly.
We need to take a break, but when we come back this time, we're going to meet with you on the street, see how you're managing this volatility.
I study the market every day, and when it looks like things are going downhill, I pull it out and put it in a money market fund. Can't lose that way.